This is why you'll never build real wealth. Not because you don't earn enough, not because the economy is rigged, not because investing is too complicated, but because you're addicted to progress that looks successful instead of progress that creates wealth. And unless you recognize this pattern, you will work harder every year and still never feel financially free. Let's break this down. The dangerous lie. You've been sold, you were told, get a degree, get a job, get promoted, invest a little, upgrade your lifestyle as you go. On the surface, that sounds responsible. But here's the hidden flaw. Income growth does not equal wealth growth. They are not the same thing. One is what you earn. The other is what you keep invested long enough for compounding to take over. And most people confuse the two for decades. The successful person who never gets rich. Let me tell you about Ryan. He saves 8% and invests a few $100s a month. At 28, he's making $75,000. He upgrades apartments, buys a better car, still saving roughly 8 to 10%. At 35, he earns $110,000. Now he travels more, eats at nicer places, lives in a better neighborhood. His savings rise slightly, but so do his expenses. From the outside, Ryan is winning. Better salary, better lifestyle, better everything. But at 40, his net worth is barely $250,000. He's been working 16 years, and he still needs his paycheck. What happened? Nothing dramatic. Just small lifestyle upgrades that matched every raise. This is the silent killer of wealth, lifestyle inflation. Wealth is built in the gap. Wealth is not built in your income. It's built in the gap between what you earn and what you spend. That gap is your investment engine. If your income rises from $60,000 to $100,000, but your spending rises from $50,000 to $85,000, your gap barely grows. Your lifestyle improved, your future barely changed. And that's why most people who earn six figures still feel financially stressed. Because earning more without widening the gap does not create leverage. The compounding reality most people never reach. Historically, the S&P 500 has averaged roughly 10% annually over long periods. Let's assume a conservative 8% return. If you invest $500 per month for 30 years at 8%, you contribute $180,000. Your final balance? Around $745,000 more than $560,000 of that comes from growth. Not effort, not hustle. Growth. Now here's the critical part. The first 5 years feel painfully slow. After 5 years, you've contributed $30,000. Your portfolio might be worth around $37,000. $7,000 in gains over 5 years. That doesn't feel life-changing. It feels like you could have made more flipping furniture. And this is where people quit. The psychological wall. Your brain expects linear results. You put in effort, you expect proportional reward. But compounding is exponential. It's slow, then steady, then explosive. Years 1 to 5, boring. Years 6 to 10, encouraging. Years 11 to 20, noticeable. Years 21 to 30, transformational. But most people stop at year 3, not because they're lazy, because it doesn't feel like wealth is being built. We're wired for immediate feedback. A new car gives you a reward today. An index fund gives you a reward 15 years from now. Guess which one your brain prefers. The market will test you. Even if you stay consistent, something else will try to break you. Volatility. In 2008, during the global financial crisis, markets fell more than 30%. In early 2020, during the pandemic panic, markets crashed again. People sold. They panicked. They locked in losses. But historically, every major crash has eventually been followed by recovery and new highs. The investors who built real wealth were not the ones who avoided downturns. They were the ones who stayed invested through them. Volatility is not a bug in the system. It's the price of admission. If you can't emotionally handle temporary drops, you'll never reach long-term gains. The raise trap. Here's where things get even more dangerous. Let's say you get a $12,000 raise. What happens next? You justify a nicer apartment, a car upgrade, more dining out, premium subscriptions. You deserve it. And yes, you do deserve comfort. But here what's the question no one asks. What percentage of that raise is going into assets? If your income rises 20%, but your investments only rise 5%, you're widening comfort, not wealth. The wealth builders do something different. They lock in higher investing rates first, then they upgrade lifestyle with what's left. That single order of operations changes everything. 2 identical careers, 2 completely different futures. Imagine 2 people, same career, same raises, same investment returns. Person A increases savings rate from 10% to 25% over time. Person B keeps it around 10-12%, but upgrades lifestyle every few years. After 30 years at 8% returns, Person A potentially crosses $1 million. Person B might sit at $300,000, $400,000. Both earned well. Only one widened the gap. That gap compounds more powerfully than any stock pick ever will. The illusion of I'll start later. Another reason you'll never build real wealth. You keep telling yourself you'll start seriously investing later, when income is higher, when debt is gone, when life is more stable. But time is the most powerful variable in compounding. Investing $400 per month starting at 25 can outperform investing $800 per month starting at 35. Because compounding rewards time more than intensity. Every decade, you delay cuts your exponential curve shorter, and you don't get that time back. What actually builds real wealth? Let's simplify this. Real wealth comes from 5 non-negotiables. 1. A high and rising savings rate. Aim for 20% plus over time. Every raise should trigger an automatic increase. 2. Broad market exposure. Low-cost index funds tracking the overall market, historically, outperform most active strategies long-term. You don't need brilliance. You need consistency. 3. Automation. Set investments to happen automatically. If you rely on motivation, you'll fail. If it's automatic, it becomes identity. 4. Emotional discipline. Markets will drop. Headlines will scare you. Friends will brag about quick gains elsewhere. Ignore the noise. Stay invested. 5. Decade thinking. Stop measuring wealth in months. Measure in decades. The first decade builds the base. The second builds momentum. The third builds freedom. The brutal truth about wealth. Here's something most people don't want to hear. Wealth is boring. It's repetitive. It's slow. It's uneventful. It's the same automatic investments month after month. It's saying no to lifestyle upgrades you technically can't afford. It's staying calm when markets drop 20%. There's no adrenaline. There's no viral moment. Just discipline compounding quietly in the background. And that's why most people will never do it long enough. The identity shift. If you want real wealth, you need to shift identity. Stop seeing yourself as someone who earns money. Start seeing yourself as someone who accumulates ownership. Ownership of businesses, ownership of assets, ownership of compounding systems. Employees trade time for money. Owners let money work independently. That shift takes years, but it starts with small monthly investments. The question that changes: everything before your next purchase, ask, is this improving my lifestyle or improving my future freedom? Both are fine, but only one compounds. Here's the bottom line. This is why you'll never build real wealth, because if you let lifestyle expand as fast as income, if you panic during downturns, if you quit in the boring years, if you delay starting, if you measure progress too early, compounding never gets a chance to work. But if you widen the gap, if you automate, if you stay invested through fear, if you think in 20, 30-year timelines, the math becomes unstoppable. Not overnight, not in 5 years, but eventually. And when it does, your investments will grow faster than your contributions. That's the moment it feels real. That's the moment wealth shifts from theory to freedom. And that moment only arrives for the people who didn't quit. If this changed how you think about wealth building, comment where you are right now. Early, inconsistent, or locked in for the long game. Because real wealth isn't built by people who are motivated, it's built by people who refuse to stop. I'll see you in the next one.